Moving on to domestic markets. So yesterday we had the MPC, and overall, the expectations from the market participants had changed recently in the last 15 days from the MPC. So at least till 15 days back, the market participants were expecting RBI to at least change their stance to neutral, and even some market participants were expecting even outside chance of a rate cut in the October policy because of overall slowdown in global growth dynamics and a 50 basis rate cut from the Fed. What really changed in the last 15 days, what we talked about was one, the geopolitical escalation between Israel and Iran, which led crude prices to go to $80, and there was also a risk of crude prices further breaching $80. There was also the Chinese stimulus, which led to jump in commodity prices and overall changed global growth outlook. So the market participants approached the MPC with very muted expectations. If we would recall, the 10-year GSEC, which had touched a low of 6.71%, almost went to 6.85% because of the change in market participants' expectations from the RBI. So they went with a muted expectation that probably RBI will not do anything. RBI will wait for all these factors to play out and then probably take some action in the December policy. But the MPC changed the stance to neutral from withdrawal of accommodation. We believe it reflects their confidence on inflation. If you look at their Brent price forecast, they're forecasting that Brent probably for the next 6 months will also remain around $80 per barrel, which is close to the current level, as they expect global growth and global demand for oil to be slightly muted. The second thing which gives them confidence is a very favorable monsoon. As we know, monsoon has been higher than the long period average, and that's resulted in higher kharif sowing as well as expectations of food grain production. We will discuss that later, but broadly what RBI is really confident on that given a favorable monsoon, although the next couple of prints on inflation will be higher than 5% because of base effect and because of unseasonal rains and vegetable prices seeing some shock, largely they expect inflation to remain moderate. They expect food price inflation to come down. And why food is very important? Because if you look at inflation X of vegetables, if you look at inflation X of food, is in fact inflation X of vegetables is close to 3%. Inflation X of food, as or core inflation, has been around 3.5%. So it's actually the food inflation for the last 6 to 9 months which has been playing the spoil sport, which has been keeping overall inflation quite high, and hence RBI had to be in the withdrawal of accommodation mode to ensure that the inflation expectations are well anchored. So yes, now they are much more confident of inflation, and that's why we are seeing the change of stance, which we view it as quite positive. They are continuing to be optimistic about growth. If you see, look at the growth forecast. They're still projecting 7.2% for FY25. They are up their growth forecast of 7.3 to from 7.2% from the previous policy, probably to account for lower growth in the first quarter this year because of elections. So probably, but that's understandable. But we think that given the slowing consumption, especially on the urban side, if you look at the GST, collection, if you look at the four-wheeler sales, if you look at the core sector output, probably the actual growth numbers could be slightly lower than what RBI is projecting right now, which opens up the space for rate cuts in the upcoming policies going ahead. So barring a commodity price shock, which leads crude to go much higher than current levels, or other commodities with changes forecast from core inflation, we think that the fact that RBI could change the stance of the current policy despite a very volatile macro backdrop globally, we think that RBI is quite confident on inflation, and also there is probably an implicit acknowledgement that yes, growth is under some risk. So if you even look at the RBI policy yesterday, the governor also acknowledged that the downside risk on growth are increasing because of this global financial market volatility, because of this geopolitical tensions, which could lead to slowdown in global trade, and hence probably we think it's a combination of slowing inflation as well as slowing growth. So of course, by the next policy, if growth continues to be at 7% plus and inflation continues to be at 5%, probably RBI may wait out. But yes, if growth is slightly lower than 7, inflation is moderating, Rabi sowing is healthy, probably RBI could cut rates starting from December itself, or they may push back to February if commodity prices are on the higher side. But we think more importantly, investors should now look at the totality of rate cuts that can be expected in the current monetary policy cycle. So for all the investors who are looking for RBI to pivot, they have pivoted, at least in terms of stance. It is expected that they will also start to cut rates once the hard evidence of inflation is also seen of declining.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.